All right, I'm going to call the November 8th, 2021 Oklahoma City Post-Employment Benefit Trust to order. First item up on the agenda are the approval of minutes, and it's my understanding we can approve all of these at one time. So it'll be A, B, and C. So I would entertain a motion. Moved and seconded. All in favor? Aye. And the motion carries. Do we need to slow down? Okay. All right, item 3 is we need to elect a vice chair trustee to preside at trust meetings and perform chair trustee duties in the absence of the chair trustee. I would take nomination.
I nominate Laura Johnson.
All right.
I notice she's not here. I hope she will accept that.
All right.
Second.
Second. All in favor?
Aye.
Aye. Motion carries. All right. Item 4 is receive the monthly investment flash reports for May 31st, June 30th, July 31st, August 31st, and September 30th. And you don't have to do every one of them, but so, okay. Okay, hold just a second.
Okay.
We got to make sure we good? All right, Doug Anderson with ANCO. Go ahead, Doug.
Thank you, Mr. Chairman and trustees. In front of you, I can't see what's on your monitors, but I trust it's exactly what I'm seeing up here. Is that correct? So after we've accepted the monthly reports, we're going to go into the September 30th full performance report. If we could scroll ahead one more page, please. Very high level here on, it's page 3 of 55 of this. The growth in the U.S. economy slowed during the third quarter. Are you seeing this on your monitors in front of you? Okay, good. Inflation is increasing. Equity markets have done very well. Bond markets have done very well. Next slide, please. If we look at for the quarter, you can see that U.S. equities were led by large caps. For the quarter, small caps underperformed. International equity lagged, and the U.S. bond market was was challenged, except for inflation-related bonds. If you look below that, you can see for the last 1 year, performance has been very strong. U.S. equities up anywhere between 30 and 47%. International equities up anywhere between 18 and 26%. However, fixed income in a rising interest rate environment struggles, and you can see the same pattern there. The only positive returns there are for TIPS. Those are Treasury inflation protected securities and investment grade bonds, and money market at near zero. Next few slides here. Not going to go into this too much. I've been given 4 minutes today. As we move on through this, you can see equities are strong. Value outperformed growth over the trailing 1 year period of time. Coming out of a recession, that is typical. Next few slides, please. A real turn here that we've seen in performance by sector. You will note that the top performing sector on the top chart, which is Russell 1000, large cap, and the lower chart, which is the Russell 2000, which are small cap stocks. Top performing sector for the last year by a pretty wide margin is energy. And as we sit here with $85 a barrel oil and with natural gas prices significantly higher than they were a year ago, interesting things are happening in the energy environment. Whereas in past periods, you would see oil prices going up and you would see exploration and production companies going out and drilling new wells and exploring new basins. However, production is not going up right now. They're being more fiscally disciplined, and rather than going out doing new projects, they are returning money to shareholders, share buybacks, dividends, refinancing debt, or if not, taking debt off of their balance sheet completely. So if the issue is that we need to pump more oil to drive the price down, it's going to take a while. It will not be as fast as last time. Next few slides, please. Actually, could you go to the one with the big green number in the middle of it? Keep going. I think that suffices for market environment. This is the one. I'm sorry, it's not colored anymore. The big green number, or the big number, is 25.7. That's the total fund rate of return net of fees for this OPEB trust for the 12 months ended September 30. Obviously, this is a handsome return. This is a big return. Let's not project this forward. We have been in an everything rally. Everything has gone up. It's not just stocks. It's not just corporate bonds, prices, housing, real estate, et cetera. Everything has been in a rally right now, and a big reason on that is the biggest fiscal or monetary stimulus ever in the history of the planet to combat COVID recession. A couple more slides, please, and I will open it for questions. Actually, can you go back just a bit there? Perfect. What we have done lately, you see the bottom 3 bullet points there, July 23rd of this year, we made share class changes. Hotchkiss & Wiley, double line bond, and Lord Abbett high income. Those went from low expense share classes to even lower expense share classes. So this is something that we do. Mutual funds often issue new share classes that are at lower rates because the market's constantly evolving, and as often as we can take advantage of that, we will. So same product, lower price, really no market exposure change over any period of time. Here's a great slide here on page 14 of the report. The gray area is effectively the corpus, right? This is how much money has been put into the OPEB trust. The blue line is the market value of assets. You can see that we have steadily, patiently increased the market value here without damaging corpus. You can see that we would have to have a significant drawdown on this portfolio to impact corpus going forward. This is not an overnight issue. You can see when we started at 2009 with about $6 million, the portfolio looked significantly different than it does today because we did not want to impact the initial investment. Where it is now is more aggressive, and it's because we have compounded returns on top of the cash flow to get to the position where you are right now. Next slide, please. That's asset allocation over time. You'll notice a shift where we went from primarily fixed income to a majority of the assets in equities, and that happened in about 2010. But again, we were cautious at the outset and growing more aggressive as we have a higher margin of safety. Next slide. Here's our allocation. 63% domestic equities. Oh, first I want to point out the market value did not change much during the quarter, $96 million. I will tell you that as of October 31, it is in excess of $100 million. So we have breached that. It's taken a while, but we have, through cash flow and returns, been able to increase this portfolio from $6 million to $100 million. So 63% in domestic equities, 16% in fixed income, 10% international equities. Further fixed income allocations are the active duration and the high yield at 8.2 and 2.3%. And always a very modest allocation of cash within the investment portfolio, although there is cash held outside of the investment portfolio in the trust to meet benefit payments. And I think I'm getting close to the end of my report. If you'll go one more, please. One more slide, please. Keep going. Here we are. Page 19. This is a comparative performance and asset allocation review. You will see the total fund composite return net of fees at the top. This is all of the investment assets in the portfolio. For the quarter, we were slightly positive at 0.1%, and that ranked in the 23rd percentile of all public plans in this market value range, from 50 million to 99.9 million. We're going to have to expand the range here now that we're above $100 million, but this is a fairly narrow cohort of funds out there. For the year-to-date period, calendar year-to-date, 10.4%. That outperformed 94% of other funds in this cohort. And then over the last year, 25.68%. You can see the outperformance versus the policy index, versus the all public plans, and also versus the actuarial assumption. Fairly wide margins there. First percentile rank. We're very proud of this, obviously. These are great results. As we go down that 1-year column of returns, our fixed income portfolio did not do that great versus its peer universe. It's a relatively small portion. It's 26.6. You can see exactly where that came from. That came from our Hoisington portfolio, which is the active duration. They're holding long duration assets in the portfolio, so 30-year treasuries, and that did not perform very well. Over the long term, it has performed very well. Over the last 7 years, it is our best performing bond portfolio and ranked in the 5th percentile of its universe. As we go down the list, Loomis Sayles is 1st percentile, Double Line, slightly more cautious, 14th, and Lord Abbott is 16th percentile. Our domestic equity portfolio, 22nd percentile rank over the trailing year. It performed or produced a return of 37.2, beating the S&P 500 by a significant margin. The components of the portfolio are the Fidelity 500, and remember we converted from Vanguard to Fidelity because it's less expensive for the same product. It tracked the benchmark perfectly during the quarter. That's why we don't have longer term results there, because these are real money returns. The mid-cap index was up 36%. Hotchkiss & Wiley was up 83% for the trailing 1 year. This portfolio does require patience at some times, but the portfolio's investments, even after being up 83%, single-digit PE ratios across the board. So the selling at a price to earnings ratio of less than 10. Amazon, I think Amazon is in the 40s, so you're getting at 1/5 of the expense on that. And a company like Tesla's PE ratio of 140. So you're paying 8 or 9 times earnings for this entire portfolio. Still very attractively priced. Next slide, please. The Stevens portfolio, it had a strong year last year, up 37.78, and Causeway International is up 37.59%. Returns have improved for that portfolio. You can see it's above median across the board. Stevens is close to median across the board, but they're a cautious small cap growth equity manager. We don't want them investing in the highest volatility, and so that does dampen returns somewhat. I would like to skip all the way through, if you can just roll pages here. Keep going. I'm not going to go over the manager slides, but as fiduciaries, it is always good to remind ourselves of the expenses that these managers are paid. Slow down a little bit. Keep going a little bit more here. First up is our watch list, if we can do that in sequential order. So Hotchkiss & Wiley is on alert, and Causeway is on alert. I would recommend taking Causeway off the watch list because their performance has been above median and very stable. Hotchkiss, they were 1st percentile last year, but they do have some 4th quartile ranks out there that I would like to see them improve before we take them off the watch list. So my recommendation is to leave Hotchkiss on, take Causeway off of our watch list at this time. And then the next slide, cost. So the expense ratio on a weighted average basis is 45 basis points for management fees, so less than 1/2 of 1% per year. The category average is 90 basis points. So that's a difference of exactly 45. You're paying half category average for the mutual funds you're investing in based on Morningstar data, and that is an annual savings to the trust of $391,000. I don't think that we're sacrificing any value for the lower cost funds here, but if you look at the list, we've been very, very good cost managers here. So the portfolio has done well, 25.7% rate of return for the last year. We rank very strongly versus peers, very good results versus our benchmarks. We have one manager left on our watch list, Hotchkiss & Wiley, and we're paying less than half of what the average mutual fund expense ratio is for the trust itself. I'm happy to take any questions.
All right, any questions for Doug? All right, Doug, thank you. I got a little trigger happy. We went all the way to 5. We need to go back to 4 and actually formally receive the monthly investment flash reports for May 31st, June 30th, July 31st, August 31st, and September 30th. So if I could entertain a motion.
So moved.
Moved by Neil, second by Diana. All in favor?
Aye.
Aye. And the motion carries 3-0.
That we voice voted.
We voted, so I go ahead and go to the next one? All right, then item 6 is to ratify the claims that were in your packet. And again, I'll entertain a motion.
I so move.
So moved by Neil, second by Diana. Neil, how would you vote?
Aye.
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 Aye. And the ratification of the claims passed unanimously.
Is Diana are you logged in now? I'm logged in.
Okay, we're going to go back to, all right. It's not letting me vote. You know what? I need to go back to my computer. All right, so ratification of claims. Item 7 is a joint resolution authorizing the renewal of the administrative services agreement with Unitedhealthcare, with the Oklahoma City Municipal Facilities Authority in concurrence with the Oklahoma City Post-Employment Benefits Trust. This is a big ticket item here where we contribute and support for healthcare costs, and I would be happy to take a motion. We have Chris York from HR if anybody has any questions. So I would entertain a motion. Moved by Neil,
Trying to get back to where it was.
second by Diana. Record your vote. And it passes unanimously. Now, item 7B is a joint resolution authorizing renewal of the modified administrative service agreement with Blue Cross Blue Shield. This is similar to the previous one with Unitedhealthcare, so I would entertain a motion for this item. Motion by Neil, second by Diana. Record your vote. That passes unanimously. Now to item 7C is a ratification of addendum for RFP for OPEB 005 post-employment actuarial services and actuary contract between the OPEB Trust and Nyhart for a term of 1 year with an option to renew 5 one-year terms. Any questions? Anything? If not, I will entertain a motion. Motion second, record your vote. And that passes unanimously. Now to item number 8. We'll receive our annual actuarial evaluation, and we have Emily Kloss with Nyhart here, who will give us a brief presentation.
Good morning. Thank you for having us today. So this is John Mallows and myself, and take these off so you can hear us. And we are actuaries that work on the retiree health valuation here for GASB 7475. Essentially what we're doing is putting together a report for your financial statements, and what that report is comprised of is a present value calculation of what retiree benefits you're offering and what we expect that to cost in present day terms. And so I was just going to introduce ourselves, and then John is going to briefly go through the plan provisions and the assumptions that we're using to calculate that present value. And then I will go over kind of the numbers section and at a high level as part of the report. So I think we'll start at page 32, if that's okay. I'm Emily Klaus. I'm an actuary at Nyhart. Work on a lot of these GASB 7475 valuations and have been with Nyhart for a little over 7 years now. John, if you want to introduce yourself as well.
Yeah, John Mallows, joined Nyhart about 2 years ago, and I've got over 20 years experience working on OPEB evaluations.
All right.
So I guess John will start here with the plan provisions, and then I'll take over with the numbers.
Okay. Yeah, so on page 32, with the plan provisions, I'm going to kind of skip over these because nothing's changed in the last year, so there should be no surprises on this page. One thing I did want to point out is the post-65 premiums are quite a bit lower than expected, and we're seeing this across a lot of our clients, and that's mainly due to COVID-19. Retirees going to doctors less often and putting off elective surgeries, that kind of thing. So it's pretty common to see a decrease in those premiums. The following pages list out all the assumptions that we used, and these are consistent with what the pension valuation uses. I'll skip to the appendix where we talk about what assumptions changed from the previous year. So on page 44, just a second to get there. One more. Okay. So on page 44, all the assumptions are the same as last year except for the ones listed here. We updated the mortality assumption, and that caused an increase in liabilities. We also updated the termination and retirement rates, which caused a slight decrease in the liabilities. We updated the payroll growth assumption, and that caused a slight increase. And then finally, we updated the healthcare trends. We reset them based on NIHART's current trend assumptions, and that caused an increase in the liabilities.
So I guess going back up to page 4 to go through the numbers portion and to kind of speak to what John just went through. To start on page 4, this is just an outline of where the liabilities were last year versus this year. And basically what you can see there is the split between the city and COTPA. And you can see that a lot of the liability is post-Medicare. This is very common for us to see as post-Medicare liabilities extend for a much longer period of time than those pre-65 liabilities between the time when someone retires and when they turn age 65. So that's where a majority of the liability is for both groups there. And as you can see, the liability is about flat for the city there in that total OPEB liability line and has gone down for COTPA. These are both lower than what we were expecting for this year. So a decrease in liabilities. So moving on to the next slide, this is where we start going through the disclosure items for your financial statements. So we show historical experience, and that also goes into the financials. But looking at fiscal year 2020, 2021, the big thing that I wanted to point out and something to look at each year, in that top table there for the total OPEB liability, there are 2 line items: changes in assumptions and the differences between expected and actual experience. These are 2 line items that illustrate, we had an expectation of where liabilities would be for next year, and these are the differences based on that appendix page that John kind of went through there. So the changes in assumptions are attributed to that appendix page that John went through. So the main driver of that for the city specifically was the mortality update that caused the biggest increase there, and that's in conjunction with your pension report, as John mentioned. And then for the differences between expected and actual experience, this illustrates we receive census data from you all each year that outlines who's in your plan, who's eligible for benefits, both now and in the future. And so with the update to the census, as well as those premium rates that John mentioned, that illustrates the difference between where we were expecting the premium rates to be and where they are now, as well as differences in the census from what we were expecting to where they are. The biggest driver of that this year was what John mentioned. The decrease in the post-65 premiums caused a decrease in your liabilities because those rates went down. So that was the biggest driver of that this year. So as I mentioned, you can see from the beginning to the end, that liability kind of stayed flat there for the city this year. Now, looking down on the plan fiduciary net position, and to kind of reiterate that the investment returns were really great this year for you all, so that caused kind of an end of year balance to be higher, in which case your plan fiduciary net position there at the bottom has increased as a percent funded from that 13.8% last year. Now it's funded at 18.7%. So overall, with the liability kind of staying flat and the assets going up, you're sitting at a better position than last year. So going on to page 6, this is looking at the COTPA group. So here we're also seeing, if you look at the changes in assumptions, it's a similar kind of story there with the mortality kind of being the main driver there. On the differences between expected and actual experience, the benefits that are provided by this group as a flat stipend, so we saw less of an impact on those premium type gains and losses. This was more attributed to the census data. There were some active employees that retired and did not elect coverage, and so when census data comes in different than what we were expecting, we modify our liability to account for that, and so that caused a decrease in the liabilities due to those folks leaving and not taking a benefit. And then the plan fiduciary net position there, again, went up from last year due to some investment income as well as the contributions made to the trust. And so for this group, the plan fiduciary net position as a percent of total OPEB liability there at the bottom, which is the funded percentage, went from 33.5% to 48.1%. So again, a better funding position than last year. And that kind of illustrates what you'll see in the rest of the report. The next few pages are kind of required disclosures that go into your financial statements. When we look at this page, essentially what we're showing here is our actuarially determined contributions. So this is something that goes along with GASB 74, where we project a contribution that we would recommend, but that you're not required to actually put into the trust. But it's just our recommendation if you have the funds discretionarily to put into the trust. So we're showing that actuarially determined contribution compared to what you're putting into the trust. And you all have kind of put in a pretty consistent amount the last several years. And so this schedule is for the financial statement purposes. And moving on to the next page, the COTPA group has also been putting in a flat amount there of $130,000 a year, which is pretty similar to our actuarially determined contribution, give or take there. So moving on, these are some required disclosures, so I'll kind of skip through these here and keep going until we get to, keep going. The sensitivity there is another required disclosure. Then we kind of outline the assets and where those are. This is for disclosure purposes and just to outline, where that plan fiduciary net position is coming from. So if you wouldn't mind continuing on until here. So this is our outline of the actuarially determined contribution, so how we get to that number. And essentially the calculations are prescribed other than, we use your long-term rate of return assumption, and then we have some other assumptions built in that can vary by entity. We're using an amortization period of 30 years. Eventually, if you get to a position where you're able to put in the full actuarially determined contribution, we would want to kind of discuss funding recommendation patterns and if we'd want to start walking that amortization period down so that you eventually reach fully funded status. Continuing on, we'll go a few more pages here. This is a projection of where we would assume that your liabilities would be next year if nothing went out of line from our current assumptions. So we're showing where we would expect the assets to be as well as where we would expect the liability to be for fiscal year 2021, 2022, if nothing changes. So you see kind of some TBD lines there as, nothing ever goes exactly the way that you expect. So we would expect there to be what we call an actuarial gain or loss there, but this is our best projection to date. So continuing on a few more slides, this is just showing kind of our expectation of where the benefit payments would come in for retirees. As you can see, that's kind of increasing into the future, which is what we normally see with inflation on medical costs. But this is our best estimation to date. Obviously, the kind of claims have come in lower the last few years, especially with decreased utilization due to COVID is something that we've seen kind of across the board. And then moving on, this is the COTPA, same kind of story there as the city, but if we continue on, this is the final slide I'll go through. So this is our discussion of the discount rates. So this is a major assumption for us, and essentially under GASB 7475, what we do is we have to blend your long-term rate of return, so the expectation of where the trust will come in, with a municipal bond rate based on your current assets and where we're expecting your asset balance to be in up to 100 years. So basically, the story this year is that the long-term expected rate of return did not change. We're keeping that assumption flat from last year to at 7.5%. The municipal bond rate went down a little bit, and so you would kind of expect that blending to be to also go down. But what happened was that the city's investments came in very favorably, and so it ended up that the blended rate actually stayed flat there, and that's what we outline in number 3 on this page. And so that's kind of the overview of our report. If there are any questions on those numbers or where we got something, we're happy to field any questions here on that. But overall, the trust is in a more favorable funded status than last year, and liabilities stayed flat, if not decreased, for the COPPA group.
I have one, okay.
Yep, I'm sorry. I had a real quick question.
Yeah.
When you look at the census data for active employees, how many years of service are they active employees who will become eligible for retirement
Right.
that year or the next year? Is that what you're looking at in your
So
census?
we look at the active employees that are anyone that's eligible for retiree health. So the cutoff date for receiving subsidy with the city is January 1, 2017. So we're looking at anyone hired before that date, and essentially someone who maybe has 1 year of service. We have different assumptions built in for whether they'll terminate before they get to retirement or when they'll retire. And so those that are closer to retirement have more liability than those that are brand new. But we're taking into account everyone that's hired as of 6/30/2021.
I just wanted to confirm, I know we had great returns last year, but you still do the smoothing effect on the earnings, or is it, how do we look at that? Typically, you look at the returns in the last couple of years, and then how does that come into play?
Yeah, so for ours, we're not doing any actuarial smoothing. That's a method that can be used. We've seen it on the pension side quite a bit. For our purposes, we don't necessarily smooth those in too much. There is a deferred inflows and outflows page where, for OPEB expense purposes, on one of those previous pages, it is smoothing gains and losses over 5 years, which that's prescribed under GASB 7475. But for your plan fiduciary net position, that's just as is.
All right, do we have any other questions? All right, well, thank you both for traveling down here
Oh
to
yeah,
Oklahoma
thank you
City.
for having us.
Yes.
Nice to see you all.
Yeah, and apparently we'll see you next year.
Yep,
So,
thank you, yes,
all
thank
right.
you so much.
Thank you.
Appreciate your time.
All right. Do we need to formally receive that actual report? So we need to formally receive the actual report, so. Amy, motion and second. Record your vote. We did. We did. Yes, ma'am. All right. Now, item 9 is the calendar year 2022 meeting schedule. Entertain a motion on that. Motion and seconds. Record your votes. It passes unanimously. All right,
So is there a list of dates for the next year?
yes.
It's on the attachment.
We'll give that to you
You can
now.
click on that little eye. And it'll show you.
It will be February 14th, May 9th, August 8th, and November 14th. Diana, I am going to confirm, we did go back and approve that other one, right?
Yes.
So, okay, just want to make sure. I need all the help I can get. Number 10, reports, comments from trustees, staff, interested party. Trustees, any comments?
No comment.
No.
Still
No?
out of breath.
Still out of breath? Staff, do you have any things you'd like to bring to our attention or any other interested parties? All right. Well then, seeing none, we're at number 11. Seeing that we are at the end, we are adjourned at 12:06.